Hey guys, my name's Colin and this is Colin Talks Crypto. This video is a response to the last video I did entitled, What is your cash out plan? Basically, what is your plan when the next crypto bull run, the run that we're a part of right now, reaches its peak? How are you going to maximize your profits? In this video, I'm going to cover some of the top frequently asked questions in the last video in the comment section and all of my answers, as well as a few tweaks I'm making to the overall plan based on user feedback and some other interesting ideas. Thank you for joining me. First of all, I just want to thank all of you who watched that video, who liked it, who shared it, who subscribed, and who commented, because there was a lot of community participation in this last video and it was really helpful. We even had the likes of DaVinci J15 sharing what he's planning to do in the upcoming bull run, and I'll give you a hint, it involves trading crypto into gold, and I'm going to get into that in a minute as well. So in this video, we're going to cover the top questions I had. The most popular question, I think the question I saw the most in this last video was, why not just cash out into fiat instead of using stablecoins? Why not just use the dollar? And my answer for this is because bank accounts can be frozen. Decentralized stablecoins cannot be frozen, such as DAI stablecoin. A small percentage of fiat is okay, but when dealing with larger amounts, banks have a tendency to want to know where that money came from. I think any deposits over $10,000 can trigger that kind of a flag on the income. And I just don't want the uncertainty. I don't want the responsibility to be in my court to have to prove where my own money came from when I know dang well where my money came from in the first place. So for me, stablecoins is not a way to escape taxes, as I'll get into in a second, as some of you also thought, but it's just a way to be in control of my own money. That's the entire name of the game in Bitcoin and cryptocurrency, and I don't intend on losing control of my own money, even while temporarily holding it into stablecoins for the next bull run preparation. Now, with that being said, it's obviously a must to do one's own due diligence. Do your own due diligence on which stablecoins you pick, because they're not all equal and they're not all decentralized. And they don't have the same features, capabilities, volumes as we covered in the last video. So it's very important to do your research on which stablecoins you do end up using if you use this system. And while I'm at it, I want to preface this entire video with this is not professional advice. I am not a lawyer, I'm not a tax professional, I'm not an expert, I'm not a trader. I'm giving you what I'm doing in the upcoming bull run. Take it for educational advice only. And the second most common question that I received was, if your stable coins are all USD pegged, like the ones you showed, won't the end of the dollar also put your stable coin value in jeopardy? And yes, absolutely. If the end of the dollar was coming, my stable coins would be absolutely, utterly obliterated and screwed. I do not personally see USD hyperinflation stages or the end of the dollar occurring in the next 2 years. I do strongly feel that we are going to see hyperinflation eventually, because it is, as I said, mathematically inevitable. You cannot endlessly print money and not expect it to eventually go to zero. The math just doesn't work for you in that case. So yes, if we were in a hyperinflation range, or if we thought that there was impending doom, the next depression was on the horizon, probably putting money in the stablecoins would not be a good choice. I do not see us at that stage of the game yet. Also, that's why I only put up to 1/2 of my crypto portfolio into stablecoins, because again, I'm distributing my risk factor over several areas, stablecoins and crypto, and a few others, as you're going to see in the rest of this video as well, because I'm looking at gold. So the way I'd summarize using stablecoins is, yes, they're pegged to a fiat, and fiat is inflationary, no doubt about that. We see a couple percent, I don't know if it's 2% or 5% or 6% annual inflation per year on various fiats like the US dollar. However, in a sharp and steep crypto bull run correction, the correction following the bull run peak, when it's gone utterly vertical, is a very steep correction usually. And it usually has a ways to go. And as we just saw, it can take 1.5 years to fully correct out. So I plan to use stablecoins as a method to hedge against that steep decline in value. And the loss incurred on the inflation of a fiat currency, let's say it's 6%, is much less than the loss incurred on a steep market correction. Therefore, the fiat is still a preferable choice when held in a stablecoin to the losses I would incur if I just held my crypto and rode it, 90% down to the bottom. 6% is a lot better of a loss than 90% of a loss when hedging one's risks. All right, now on to gold, silver, and real estate. So Da Vinci was really kind to drop by and add his 2 cents. He said he's going to be using a service called Vaultoro.com to trade Bitcoin for gold during the next bull run high. And that's his method for hedging his risk during the market correction. And I took a look at it, I registered with that site, and within a day I was verified and approved for unlimited volume. I'm still researching it. I want to do the research. The guys seem like good guys behind it. They've been around for 4 years. I just want a little more confidence that it's a safe place to put my money. But basically it's like a stable asset. It's not a stable coin, it's a stable asset. You're getting gold for the Bitcoin or the crypto that you convert to Bitcoin and then trade for gold on Vaultoro.com. So I'm strongly looking into this as an option. And actually, I'm going to revise part of my plan to include gold as part of my diversification. And several of you have recommended that, and I think you're dead on, so I'm going to be doing that. So with the 50% pie slice that I'm putting into stablecoins, of that 50%, I'm going to put about a quarter into gold directly. So that leaves only 3/4 of the 50% that will actually go into stablecoins. And then of that 3/4, I'm going to put maybe 1/8 or so into fiat directly into my bank account, and then the remainder will end up in stablecoins. So actually you can see in the pie slice, I'll draw it here, so I have a bit more of a diversification when I've modified my plan here. So we have the predominance of the 50% in stablecoins, but then we have a quarter of it in gold, and we have about 1/8 or so, maybe a little less, in fiat itself, just for spending and living on during that 1.5 years when the market declines. That is a long time. And then the remainder in the stable coins. Also, don't forget to save money for taxes, and we'll cover that in a bit as well. So back onto the gold, silver, and real estate. Gold could offer a better hedge against fiat inflation. It depends on which way the market's going on gold, of course. That's why I'm just putting a quarter into it. But as we said, inflation of the dollar could be 6% a year, and gold could go up in value for all we know during the next crypto market correction. So I think that's a good place to put some of my money. And I just want to ask you guys, because there's probably more of you out there who know of services like Vaultoro that are reputable, long-standing, and have good customer feedback for trading crypto directly to gold. I do not want to have to trade my crypto on an exchange, pay a fee, have it sent to my bank account, then send my bank account money to another exchange, trade it for another fee to get the gold on some other exchange. I want to cut out all that mess in the middle and just go directly from crypto to gold or silver. So if you guys know of another reputable site that's as good or better than Vaultoro, or if you had a good or a bad experience with Vaultoro, please let me know, and we will figure this out together of what's a good place to put our money into a hard asset at the top of the next crypto bull run. And also onto the subject of real estate. So some of you mentioned real estate, and I do think that's a smart place to put one's money as well. It's another diversification. However, it depends on where the real estate market is. Currently, I'm renting a home in Puerto Rico for this exact reason, because I do not want to put my money into the real estate because it's at a relative high. I feel like this is a poor time to buy real estate, and so I'm renting. And likewise, at the next bull run high, if real estate is still super skyrocketing high, I'm not going to be putting my money into it because there's really one direction that it's more likely to go, which is down. So I would really only use real estate as a diversification and a hedge during the next crypto market bull run, peak, and correction if real estate had basically like a housing crash, or it was at the bottom. If it had corrected dramatically in the next 1.5 years or so, then I would definitely consider it as a place to hedge some of my money. But otherwise, if it's still skyrocketing upward, I'm not going to be putting my money in it. You want to buy low, sell high. You do not want to buy high, sell low. So personally, I'm going to be staying out of the real estate market if it's skyrocketing upward still. So to summarize those points, it really seems best to put my eggs into various places, not into one basket when hedging on the downturn. So stable coins, a little fiat, gold, silver, and maybe some real estate if real estate is on the low on the market. So thank you, Da Vinci, for bringing that to my attention, and all you other guys as well. All right, I made a couple of important points here. One, do not store stable coins on an exchange. I cannot emphasize that enough. That defeats the entire purpose of using stablecoins. You might as well just send your fiat to a bank account where it could be frozen as well. And stablecoins do add another factor of risk, I think, because it's not only pegged to a dollar or a fiat, but it's also a stablecoin, which has its own inherent risks. technologically, like is it sound and that kind of thing. So you definitely don't want to add more risk than you need. You don't want to be storing your stablecoins on any exchanges. If the exchange forces you to keep it on the exchange, that stablecoin, I wouldn't even buy it. I will only be purchasing decentralized stablecoins such as DAI, which you can store on a Ledger Nano S and you can store offline. That's the kind of stablecoin I'm interested in. So please guys, do not store large amounts of money on an exchange, whether it's in a crypto or it's in a stablecoin or it's in fiat. Just don't put your money on exchanges and leave it there. Time and time again, bull run after bull run, exchanges have been hacked, money has been taken, stolen, confiscated. The name of the game in Bitcoin and crypto is put the money in your control. Be your own bank. Apply that with your stablecoins as well. All right, and moving on to the next important point here. Important point number 2, taxes. Make sure to set aside enough money to pay for the taxes when you convert your crypto to anything else, including other crypto, stablecoins, or fiat, because all of these are considered taxable events. This is why I moved to Puerto Rico. So if you think about it, when you are at the top of a bull run peak and you've got all this cash, right, or all this crypto worth a lot of cash, and you're hedging and you're diversifying, you owe taxes in most jurisdictions, including America, if you make a trade on your crypto. And I noticed a confusion that people often think that by trading crypto to crypto, you don't get taxed, or by trading crypto to stablecoins, you don't get taxed, or it's some kind of method of tax evasion. Those are all taxable events. They are all taxable equally as trading crypto for fiat directly. So whether you trade crypto for stablecoin, crypto for fiat, or crypto for crypto, those are all equally taxable events. Just wanted to share that with you guys. That's my understanding, and definitely consult your own tax advisor, your own legal expert, and do not take what I'm saying to be legal advice. And so that's actually why I've taken preemptive measures to move myself to Puerto Rico, where I reside right now. Because as an American citizen, if you move to Puerto Rico, you can qualify for Act 22. And Act 22 basically gives you the ability to have 0% on all crypto tax gains, on all capital gains, whether it's short-term or long-term, 0% across the boards. And so I now live in Puerto Rico. I have my application in and I'm going to qualify for Act 22. That's a part of my plan that I didn't share with you guys last video. So moving to a tax-friendly jurisdiction is a way to keep all your hard-earned gains. If you make the best decisions possible, even if you trade at the utter peak and the utter bottom, you're gonna have at best a 20% tax rate for long-term gains in America, and at worst like a 37% for short-term gains. And so no matter how good you are, that theft is going to totally devastate your gains. So I highly recommend you consider something like Puerto Rico or another country where you will be given 0% or very, very low percentage capital gains tax treatment on your crypto trades. So I've already done that. Again, my actions speak louder than words. I moved here because of Act 22 and the gains it will enable me to take advantage of during the next crypto bull run high. And that just puts more money in my pocket at the end of the day. One quick note on Act 22 is I believe by June 30th, by the time you see this video probably, the current benefits do change a little bit. And so it's still a good deal to move to Puerto Rico, but they do change a little bit. And you definitely want to do your own research on this. I believe the annual required charitable contribution goes from $5,000 to $10,000. That's one of the requirements for Act 22. You have to make a donation to a nonprofit organization. And another change is that cryptocurrencies are explicitly covered, which is actually a really great thing. And here is a comment from a user, Jason Bouchard, and he said, you can of course do your due diligence on TUSD, but I've been using it after the Tether craziness, and so far it has been working really well. It sits mostly on my Trezor as an ERC20 token. Generally, since it's on the Ethereum network, it's faster than BTC. So he's sharing that we can also use TUSD in addition to DAI stablecoins, so I'm definitely going to be checking out TUSD. I am only going to be getting those stablecoins which I can store on a Ledger Nano S. That puts the money in my control. So thank you very much, Jason, for that advice. I'm going to be checking that out. That might be my second stablecoin that I use. Okay, and on to the third most popular user viewer question. What happens if the market only goes up 45x? Am I going to sell nothing? Because I said that I'm going to start selling when my crypto holdings reach 50x of their previous low to where they've gone to. 50x will be the starting point, and then up to 66x, right up to here. But what if it only goes to 45? What if I don't even see the 50x? What am I going to do? And I thought about it, and I think what I'm going to implement is a bit of a sliding scale, proportionate transfer into stablecoins, rather than just straight up 10%, 10%, 10%, 10% liquidating into stablecoins and gold and whatever, real estate and things like that. I'm going to start lower. Maybe I'll do 3% or 5%, maybe around 40x, just to be a little more conservative, and I'll increase it as we go up. So I hit 45x, I'll go to 5%. We hit 50x, I'll do 10%. We hit 55x, I'll do 15 more percent. We hit 60x, I'm gonna do 20%, 25%. We hit 65x, I'm gonna do like 30% or 50%. I'll keep increasing the amount of crypto that I'm liquidating to take advantage of the higher prices. And that will weight the average that I'm selling at a higher range, and that will just be more profitable for me. That also allows me to take some profits at a lower range, around 40x, in case it never hits the 50x. And you could say, well, what if it never hits 39x? Well, am I going to have no profits at all? And my answer to that, and I answered him here, and I said, I have to draw the line somewhere, or it becomes a continual game of undercutting myself. That's why making a good estimation of where the market will end up could perhaps be the most important part to this entire plan. It is critical to have an idea of where the bull market's going to go. If you think it's going to go to 500,000, you don't start selling at 100,000. But if you only think it's going to hit 100,000, then you might want to start selling when it hits 50,000, for example. So for me, I do think that the crypto market's going to exceed 50x. I think it's going to hit as high as 66x. And so I'm going to start selling in that range, 40x, 50x, and on up increasingly, like I just said. And another thing I want to point out is I'm not literally going to be looking at just a single crypto when doing the multiplier. I think what I'm going to do is I'm going to look at my entire portfolio. And the purpose for me holding multiple cryptos, I currently hold EOS, Ethereum, Bitcoin, and Bitcoin Cash. I only hold 4 main cryptos. And the reason that I'm holding 4 is, again, diversification. And so why would I just look at one crypto and diversify one crypto when the purpose of my portfolio is to be diversified? So the manner in which I'm going to be doing this is I'm going to look at the entire portfolio value at the low, when it hit the low in this last crypto cycle. And then I'm going to look at when my entire portfolio reaches 40 or 50x to begin liquidating into stablecoins and assets. That's the method I'm going to use. I'm not going to be going, okay, well, ETH hit 66x, so I'm going to start liquidating it, but Bitcoin didn't, so I'm not going to liquidate it. I'm going to use them all as a general average and liquidate them all evenly, because some will perform better and some will perform worse. And I don't know which those are. And that's the entire purpose of being diversified in the first place. So I'm going to probably do it like that. But you know, if I do see one crypto go to 150x, something crazy, you're going to be damn sure I'm going to be liquidating more of that one because it's so irrationally high. So it's kind of a think on your feet, but I am going to be generally treating my crypto portfolio as a unified whole. And then I'll look for any outliers and treat those accordingly as well. It's kind of like be smart with your trades. And if you're curious about what my logic is for Bitcoin reaching $218,000 if fees don't inhibit its growth, look at my last video entitled $218,000 Bitcoin, where I lay out the math and the time frame for why I think that Bitcoin's going to hit $218,000 by January of 2021, the year 2021. Okay guys, and lastly, I'm going to share with you a link, I'll put it on the screen and in the description below, to a report that a user shared with me. And this is a very comprehensive report, and it goes over what is a stablecoin and what years were they made. And you can see that there's more and more stablecoins created into existence in the last more recent years. And already in 2019, we've seen quite a few being made. So I think we're on a definite trend. Stablecoins are definitely a thing that's here to stay, and we're just going to see more and more of them. So I think by the time we hit the next bull run peak, it's going to be an awesome place to put one's assets. So take a look at this link. I recommend it highly. All right, guys, thank you so much for joining me. I hope this was educational. I hope this answered some of your questions. And thank you for sharing this video. Thank you for liking. Thank you for subscribing. I just hit 15,000 subscribers, which is really awesome. And that's all owed to you guys. Thank you so much. I hope you have a great day, and I'll talk to you again soon.